Let's stay on the market here, bringing in our first guest who says the CPI numbers are worrisome but not scary, and that inflation continues to rise, but it's not scorching hot. Joining us now is Wells Fargo Securities Head of Macro Strategy, Michael Schumacher. Michael, great to see you. Does today's data, whether it be claims or CPI, change your expectations at all?
No, look, September's baked in. I think that's pretty clear. To me, the much more interesting thing is what's the long-term prognosis for the Fed. And we do think the market's going to look at it and say, hey, we're pricing 285 or something like that for the end of this cycle. The Fed tells us neutral is about 3. That's way too narrow a gap. It needs to get bigger. So what it really means, we think, is the market's going to price more aggressive Fed activity, more easing. That's going to pull down yields somewhat, not a ton, but 2-year, 3-year yields, those sorts of things probably fall 20 basis points over the next month, 10-year a little bit, but I do think the market's going to price and anticipate more cuts by the Fed.
We're having a debate here on the desk between Steve Leisman and Rick Santelli about inflation and the inflation we continue to see. We saw it today in the CPI number and where it comes from. Rick making the case that maybe it's not from tariffs. Maybe there is an underlying inflation issue. And I'm wondering if you see that argument, and if so, all those Fed cuts that are being baked in for the rest of the year, they could be in jeopardy, and that could be really a huge problem for markets to go higher.
Yeah, I think it's more tariff-based. So if there's a structural inflation problem, that's a huge issue. I grant you that. And you made that excellent point, Melissa. So I take the other side from Rick here. Not as concerned about that. But we disagree, frankly, that the tariff notice, if you will, as far as inflation goes, is over. Our econ team and Sarah House does a great job. They're calling for inflation to run hot for a good 6 more months. So it's not the end. Maybe it's the beginning of the end, but it's not the end just yet.
And, Michael, in terms of how the labor market is shaping up and how that does or doesn't reflect what you think is, overall GDP pace, I think it's an interesting back and forth. There was a few months ago when Chair Powell was pointing to 4.1, 4.2% unemployment and saying that means we can wait. And the market seemed to be saying, oh, no, that's going to be a head fake because we're seeing softening and we're seeing tariff friction. And now you see the labor market data softening up, and it's not really being matched up with some of the other indicators. So what are we to believe?
Yeah, the labor market's been interesting. When you think about the path over the last year and a half, if you look at some of the, call it secondary indicators, a lot of people like to talk about job openings to unemployed or the quits rate. They weakened a ton from late 22 to mid 24 and sort of sat there for a while. The layoffs rate, though, has been really steady. It went up just a little bit in the last month. If that goes up a little bit more, I think people are going to say, well, it's not just these things like JOLTS. It's not simply the quits rate. It's layoffs. It's non-farm payrolls. There's more to it. So the story that the labor market's getting weak, it's gathering momentum. And I think that does have the Fed leaders pretty concerned. And that's probably why we got 2 dissents at the last meeting.